Account size. Now you can use any account size for forex trading, but it's better when you have a larger account size. But you can use any account size and you can grow from there, right? Now the trading account size does not matter. Let me highlight here. The trading account size does not matter. It only matters when you want to make so much, right? But for this strategy, the trading account size doesn't matter. It's how you manage your trading account that makes the difference. How you can have a $10,000 account and then you still blow the account at the end, while somebody can have $1,000 account and grow it to $10,000 over time, $10,000 over time. Yeah. So how you manage your account makes a difference. Know your account size and how much to risk per trade. The bigger your account size, the smaller you risk per trade. The bigger your account size, I want you to remember this. The bigger your account size, the smaller you risk per trade. The bigger your account size, the smaller you risk per trade. Don't forget this. Even if you forget every other thing in this particular section, don't forget that the bigger your account size, the smaller your risk per trade. Okay, there's a table here. Now, for those who have a $10 account, you can afford to risk 10 to 20% of your account. 10 to 20% of your account is just $1 to $2. 10% of a $10 account is about $1, and then 20% is about $2. So if you are risking 20% of $10, you are risking just $2, right? And if you are risking $2, your profit target should be $4. If you are risking $1, your profit target should be $2. Why? Why should it be like that? Because for each percentage of your accounts you risk, you should be making at least double the amount. That's when it makes sense. If you are risking $1, you should be making $2. If you are risking $1 to make 0.50 cents, then every time you lose a trade, you lose $1, and every time you win a trade, you make 50 cents. And then when you lose 2 trades, you lose $2, and when you win 2 trades, you make just $1. That means you are still negative $1, right? But every time if you are having a 1 to 2 risk to reward ratio, if you are risking $1, like in this table, to make $2, right? Every time you take a trade and it goes in your favor, you make $2. So if you have 2 trades, 2 losing trades, you lose $2, right? If you're risking $1, you lose $2 for 2 losing trade. Then if you have just 1 winning trade, you will cover your loss. You will be at break even. No loss, no profit if you win just 1. So for every 2 trades you lose and you get just 1 trade in profit, you would have recovered your loss, right? Okay, let's do this analysis. If you have a series of 5 trades and then you lose 3 of those trades, those 3 of those trades, and then you are profitable in just 2 of them, when you are risking $1 to make $2. So if you risk 3, that means $3, right? $3. Then you've lost $3. Then if your 4th and 5th trades are in profit, you make $4 because each trade you make, each profit you make is $2. So you make $4. So if you minus $3, which was your negative trades, from $4, which was a positive trade, just 2 trades, you still have a positive of $1, still be in profit of $1. So now you lost 3 trades. You lost 3 trades. You were not consistent. You were not consistent. You lost 3 trades. The number of losses you had, it's higher. 3 trades, right? But at the end, you were still profitable. Even after just being profitable in 2 trades, you were still profitable at the end, because each time you lost $1 and $3. If you had 4 losses, if it was a series of 6 trades and you had 4 losses and just 2 wins, you will still be at break even. So for every time you lost $1. So 1, 2, 3, 4, 4 losses, $4. And then every time you won, you had $2. So just 2 trades, you give it $2. Let's see. I think we should take that down. 4 losses for L, and just two profits. And you will still be a profitable trader. You had 4 losses and 2 profitable trades. You will still be a profitable trader, because what you risked in those trades, those losses, is just $4 altogether. And what you made in those 2 profitable trades, it's $4 also. Because every time you risk one, you are risking one to make 2. So you risk 1 to make 2. You had 4 losses. First trade was a loss, second trade was a loss, third trade was a win, fourth trade was a loss, fifth trade was a loss, but the last trade was a win. So you end up breaking even. No, not losing any dollar amount and not winning any dollar amount. So that's it. But if you had equal losses and equal profit, you end up still a profitable trader. Let's say you had 2 losses and 2 profits, right? You had a series of 4 trades, or let's say a series of 5 trades. Let's go 5 trade. Series of 5 trade. You had 2 losses and you had let's take that down. Okay, 2 losses, 2 loss, and 3 profitable trade. So remember, you are risking 1 to make 2. So every time you lose 1. Every time you lose 1. So what you have here is negative $2. So every time you are profitable, you make 2. Every time you are profitable, you make 2. So what you should have here, since you are profitable 3 times, which is 2, 4, 6, so you are positive $6. Positive $6. So is this not amazing? If you should remove or subtract the $2 negative from the $6, you still end up being positive $4, right? You still end up being positive $4. It's as simple as it. So that's why your risk to reward ratio should be very precise. Right? Now we're just risking 1 to make 2. So there are times where you can risk 1 to make 3, 1 to make 4, 1 to make 5, and even to make 6, right? Depending on your risk tolerance. So, but for this strategy, you should always at least risk 1 to make 2, not 1 to make 1, not 1 to make half, but 1 to make 2. So let me quickly erase all this, and then we'll go back to we'll continue with this. So just trying to erase this. So you can see in the next one you're risking 5 to 10%. In the next section you're risking 5 to 10%. Why am I risking 5 to 10%? You should ask. Now we have a higher capital. The first we had just $10, and we were risking 10 to 20% because $10 is very very small, and to make a reasonable amount, imagine you're risking just 1% of $10. That would be like 10 cents or so. So you can't be risking 10 cents per trade, and because it will take a longer period for you to be profitable like that. So you have $100 right now, so you are risking 5 to 10%. 5% of $100 is like $5, and 10% is like $10 or so. So every time you are risking $5, you should be making $10, and every time you are risking $10, you should be making $20. That easy. Is that reasonable from the analysis we did here for the $10 account? So you should also apply same here, right? So every time you are risking, if you have a $1,000 account, you should be risking $1 to $3. Now, what I'm trying to say is that the higher your account, the bigger your account size. Look at it here. The bigger your account size, the smaller your risk per trade. So when your account size was $10, you were risking 10 to 20%. Now, when your account size is $100, you are risking 5 to 10%. But now that your account size is $1,000, which is higher, you're risking 1 to 3%. Now, once you're risking 1% of $1,000, you're risking basically $10, and then 3% you're risking $30. Right? Risking $10 will make $20, and $30 will make $60. If you check the amount, the expected profit for the $100 is still bigger than the $10, and then the expected profit for the $1,000 is also higher and bigger than that of the $100 and of the $10, right? So per trade, you're risking $10 to make $20, $30 to make $60, right? You can risk 2% still for this $1,000 account. That's $20 will be making $40, right? So if you have a $10,000 account, you should be risking 0.5 or less, 0.5 to 1% account, right? You should be risking 0.5% to 1% of your account. If you're risking 0.5% of your account, of a $10,000 account, you're risking basically $50 to make $100. And if you're risking 1%, you're risking $100 to make $200, right? Now I'll tell you the reason why we are risking lesser percent per account, and why you're taking lower risk when your account is bigger. Now, if you're having above $10,000, you should be risking 0.5% or even lower than that, and then doubling it to make your profit target, right? You double whatever you're risking will give you your profit target. That's why you have no figure here. You can risk from 0.5 downward, and you double it to give you what you are risking, double what you are risking to give you what you should make in profit. Now, it will take a series of, if you're risking in this $10 account, if you're risking just 10%, to take a series of about 10 trades, 10 losing trades to take you out of the market, 10 series of losing streak to take you out of the market, right? And if you have 10 losing streaks, man, that's a crazy one. That's a crazy one. I don't think I've seen anybody have 10 losing streaks, right? So to take 10 losing streaks to take you out of the market, if you are risking 20%, it will take 5 losing streaks to take you out of the market. So you get to stay longer in the market the lower percent you risk. So if I'm risking 0.5% for my $10,000, to take a lot more trades, I'll still be in the market for a long time before I lose my account, right? If I'm risking 1 to 10%, I'll still be in the market for a long time. If I'm risking $5 for a $100 account, I'll still be in the market for a long time. Even if I had 10 losing streaks, I will still be in the market, because it's just 5, 10, 15, 20, 25, 30, 35, 40, 45, 50. That will just be half of my account, and I'll still have $50 to trade if I'm still trading the $100 account. Why? If I'm trading a $1,000 account and I'm risking just 1%, which is $10, so even if I have 10 losing streak, which is 10, 20, 30, 40, 50, 60, 70, 80, 90, 100. I will just be losing $100 for 10 losing streaks, right? 10 losing streaks, I will just be losing $100. All right, which is not hard, which is very hard to come by. 10 losing streak is very hard to come by. If I'm trading a $10,000 account, I'm risking just 0.5, which is $50. Then it will take, even if I have 10 losing streak, which is 50, 100, 150, 200, 250, 300, 350, 400, 450, 500. So I'll be losing just $500 in 10 losing streaks. So I'll still have $9,500 still to trade after having 10 losing streaks. While if I have 10 winning streaks, I'll have at least $8,000. I'll have $11,000, right? $11,000. So that's the bigger picture. That's why you should risk lesser of your account when your account is bigger. You'll be able to stay in the market for a longer period while you are still making higher amounts in capital. You can see that this, you can see right here that this account for for a $100 account size, the profit target you make is higher than that of the expected profit is higher than that of the $10 account, and then the expected profit for the $1,000 account is also higher than that of the $100 account, and the expected profit for that of the $10,000 account is higher than that of the $1,000 account. Not because I'm risking more, but because I have a bigger account, and then I'm risking less of whatever I've risked in the previous account side, right? So this is how you are going to be able to grow your account and stay longer in the market and be a profitable trader. Remember, I am Constant Mogi, and this is the best forex trading strategy. All you need to be a profitable trader. Remember to give me a 5-star rating at the end of this